So good evening, friends. Today we'll continue with our mode series. So this time we are covering cost advantage again. So get smart, get close, or be unique. Okay. So what it is, this is basically the price-based advantage. Okay. Uh, so basically, you have a price-based advantage here. Now, what is the meaning of price-based advantage? Means whenever you have a cost advantage, you will have an edge over your competitor. So what we are trying to understand here is what are those points where you can have cost-based advantage. Okay. I just request everyone, please keep in yourself in mute, please. Others we should not get disturbed. Okay. So what we are trying to do is we'll deep diving into what qualities we have to look where it gives cost leadership. Okay. Again, this is from the book, The Little Book That Builds Wealth. Okay. Very interesting book. So from there I have extracted the data. And I'll cover some few Indian examples also. Okay. So what is the core concept? Understand the cost advantage. Identify where the cost advantage matter most. So that we will see how. Then from where it can come. Okay. So cost advantage can come from process innovation, strategic location, unique asset ownership, and economics of scale. Economics of scale, it's a full-fledged separate presentation. So I'll take separately. And we'll take case study, comparative analysis, and summary. All those things I'll take here in this presentation. Okay. Now, so there are two parts to most. What is companies can build competitive advantage by either commanding a price premium. So this we have already covered. We have covered intangibles, we have covered switching cost, we have covered network effect. Correct. Now what we are covering, we are covering operating at a sustainably lower cost than competitors. So this will again give us moat. That company who has a lower cost will have edge over the competitor. Okay. Now, what is the most important question is this cost advantage durable and defensible, or is it easily replicable? So why I have highlighted this is whenever we will talk about this cost part, end of the day, will any particular company, we will ask this question whether it is durable or not. Because if it is not durable, then there's no point in buying that stock. If you buy based on that, and then obviously the competitor will follow soon and there will be no edge. Okay. So what are the false modes? Moving manufacturing call center to low cost region. How? So say for example, we have auto parts supplier all sourcing from China neutralizes any individual cost advantage. So say I source cheaper raw material from China, and my competitor is also next knows the from where we are doing, and he also starts buying from China. So there is no edge, correct? So if competitor can replicate it, then that is not an edge. Okay. Now let's see how it comes. So cost advantage are most powerful where price is a primary driver. So again, second point is first here what we understand whether it is replicable or not. Second, what we have to keep in mind is if that particular product, okay, which we are analyzing, price is a primary driver, then only it will make sense. Okay. If you're talking about luxury, price is not the primary driver. So again, we should keep in mind is two things. One is whether it is replicable, and second, whether price is a primary driver or not. Okay. So now let's see. So look for industries with easily available substitutes. So if products are technically differentiated, okay, and if they serve the same core function, then there is no difference. Okay. Now we'll take some examples. So okay, I have taken two examples. One is AMD processor of AMD and one is processor of Intel. Okay. Now here what will happen is price performance ratio is the key. How? Say AMD is costly and Intel is cheap. Okay. If both are giving the same performance, it is irrelevant for me. No, so then it is relevant for me to I go to Intel, correct? Because Intel is less cost because performance is same. But if AMD is costly, but performance wise it is much better, then what will happen? I'll go to AMD, correct? So then what we have to see is price performance ratio is the key. So when you are comparing two products and both are performing everything same, then cost is the key. But if performance is very good, then cost may not be the key. Person will go where cost performance is very high because it will match to the it will result in lower cost in the long run for that particular user, correct? So AMD makes a chip that is much faster than Intel. You might choose the faster computer, even if it's a bit more expensive. Performance temporarily beats cost. Okay. Next, this aircraft, Boeing 737 or Airbus A320. Both are same in functionality and all. Number of seats, fuel consumption, everything. Then whoever will both, you are buying number of aircrafts more, and whoever is giving you lower cost, you will go with that. Correct. Same thing with Ford and Honda. If everything is same, you will choose one with lower cost. Correct. Mostly. Now, what are the sources of cost advantage? So one is cheaper process, better locations, unique assets, greater scale. So this we'll discuss in the next session. Now, three things are there. One is cheaper process, innovating a more efficient method. So what we do is we're trying to find a process which is innovative. Means as a company, we have identified certain processes which by adopting that process, our cost of production or delivery or operation is coming down. Okay. Now here what will happen is competitor may take some time to understand. Okay. To understand what process we are following. And that is where if we are able to scale, it will give us an edge. Second is better location. Again, we have some resources like uh, iron ore mines or salt place or some chemicals where we are able to find in some unique location, correct? So that will give an edge. And unique assets like same world-class resources and all. Okay. So let's see each one of them separately. So say existing companies. So for example, process we are talking, correct? So if process is replicable by the competitor, then there is no edge. So one example I can give, which I know Titan has done very good in supply chain. They did consulting with Goldrat Consulting, and they did very well in their. They're losing lot in inventory, but when they had this consulting firm, very less money was stuck into working capital, and they saved a lot of money and did very well. Same thing with DMart. What they do is they operate in very low price, minimal advertising. They have their own stores. Biggest cost saving for them is they have their own store. They don't rent it. And very, very efficient supply chain. You can see that 10, 15 days, the product is about to expire, but that you will find in their store and they are able to sell the whole stock. So why that is happening and other not able to replicate because of efficiency in their supply chain, how they have managed, correct? And not other people are able to replicate that, correct? So how you will get advantage when you are a first mover advantage. So the innovator can gain scale before competitor reacts, correct? Now strategic and potential competitors may try to copy but execute poorly, correct? So that is if process is very good, we'll be able to scale. Another example I can give is of Southwest Airline. What they did is they have only one kind of aircraft, that is 737. So their pilot, mechanic, flight attendant, they only need to do training in only one kind of aircraft. Only keep that particular airplane spare parts. They do point-to-point flow because between. So what they do is they fly between the cities and avoid crowded and expensive big hubs. So they don't go international. Fast turns planes were at the gate for only 20 to 25 minutes. So less turnaround time, and they spend more time on there. No frills, no assigned seats, very important. See, so interesting. No assigned seats, no first class. This made boarding faster and simpler. You just go, whoever gets the seats, you just sit. So they did very good, Southwest Airlines. Now, why big airlines are not able to copy? Because they have so many planes, different kinds of plane. They have first class, and what happens is again they have to train, correct, for them. So it was impossible for them to change without destroying their own business. Southwest, so staff trained on the other planes, abandoned their multi-billion-dollar hub airports, and they are going international. So what is happening is they have so many planes and so many places, correct? So that is why they are not able to copy. So low cost and going between cities, offering less fare also, they did very good in terms of process. Same thing with Dell, very, very interesting case study, built to order, whereas others were IBM and Compaq, they were going through distributor and stores. Stock is there with the distributor. Working capital is stuck. But what Dell did, very smart thing. They took the order online from the customer and then only created the inventory. So there almost no inventory because everything is built to order, correct? And direct sales to the customer. So again, cost effective. There is no middleman. There is no markup, retail store or anything like that. So still, this is a very big, beautiful example for Dell. Okay. And I remember like once my laptop was some problem was there, person came to my home, took it immediately, replaced some problem is there. So very, very efficient sales, after sales service also. Correct. Dell. So that also helped.
But in fact, Neeraj, even
Yeah.
now,
Mhm.
Dell is keeping inventory actually, and that is the reason that they came into loss. I have a few friends of mine in Dell,
Mhm. So now
so
they
they
would
also
have changed the what do we tell their method of
correct. Yeah, they
working.
saw all these other people doing this thing, right? So they were a little worried that they might run into shortage in the market. So
Mhm.
that's how it happened.
Yes. So this example I have taken from 1990s. Okay. So they
Yeah.
did
In
very
fact,
good.
even that Southwest airline that you told,
Mm.
so they were all see how the flights make money is because they should always be in the sky. Then only they'll make
Sky.
money.
Yes, yes,
So
yes.
they were always there in the sky, and
Yes.
their turnaround time and all the stuff, even the cleaning, everything was like 12 minutes, or if I'm not wrong, actually.
Hmm.
In fact, I can share you the video on the group. It's a very
Okay.
big video, but I can share it for
Awesome.
everybody. I have a very
Yes.
one good this one on this. We did
Hmm.
a case study in VF actually.
Arre वाह.
Mm.
So I think they have 100 destinations from 42 states. Southwest Airlines. I'm not going in deep, but what I know that the lowest cost carrier from Dallas and around 100 destinations they are covering in 42 states like that. So limited to that only. They are not trying to go international or trying to expand too much like that. So wherever they are like managing very efficiently like that. Southwest. You are right. Yes. Next is this nuclear steel. So again, what they did is arc furnace. Okay, very very important because compared to the old way is what is the expensive way is iron ore and coking coal. When you do through that, it will be expensive, but when you do through electric arc furnace, cost will be very less. So that is where they had an edge. But whereas big mills, they are not able to immediately go into electric arc furnace, so they lost there. So that was the edge with nuclear steel dynamics. Next is location based. Okay. Now, so till now we were discussing about process. Now I'm talking about location. Okay. So here what happens is if you are very close to the customer, correct? Then what happens is your cost will be very less. Okay. So for example, say the companies with assets who have quarries, landfills, cement plants. Say there is a cement plant in a particular city, correct? So nearby for them, the cost of transportation is very, very less, correct? So they will have an edge in terms of cost, correct? So you will see there will be so many regional players, but when you go there, regional players people will prefer rather than going with an international level player, correct? So in cement and all, you can see all local players will have a very, very good edge in their area of territory, okay? So one example is POSCO, because POSCO is very close to Korean Peninsula, which is a massive automobile hub. Correct. So they are able to supply all this uh, steel to all these automobile companies, and very close to China also. Only a day shipping time from the world's largest steel consumer. Correct. So while POSCO must import raw materials, a cost negative, its unparalleled location near massive customer gives a significant transport cost advantage over global rivals like Brazil and Russia. Again, India example is Tata Steel, the lowest steel cost producer because they have their own mines. And if you go little bit research, they are the lowest cost producer for steel, Tata Steel. One more example here I have taken waste and hauler inquiries from US. Again, they supply gravel. Now it's $7 per ton. Now imagine this a competitor who is 10 miles away. For him, it will be 0.15 into 10 miles. The cost will increase to $8.5. Imagine a competitor who is 30 miles away. For him, it will be $11.5. So if you see the difference between the both, cost increase due to additional 20 miles is $3. That is almost 35% of the cost. So that is the kind of edge companies have when they are close to the customer or with near the cities like that. Okay. Now third is unique asset advantage. Now very interesting. Here one more thing I wanted to tell. Value to cost ratio. This one. Low value to weight ratio. Okay, this is also very important when we're talking about location based. What happens is, why this is so important? What happens is, if your uh, value is less but weight is more, correct? So this that dynamic becomes very, very important, correct? Because you are carrying more quantity of goods and value is very less. So what will happen is your main cost is transportation, correct? So always remember this, that location when you are talking, and that there again value compared to the weight is very, very less, then this dynamics will play around. Okay. So here I spoke about value to weight ratio, and there it was about price to performance. Okay. So these two things you should keep in mind. Okay. Now, unique asset, that is resources we are talking. So what will happen, owing a resource deposit that is uniquely cheap to extract due to its scale, quality, or location. Okay. So this is not about skill, but about owning the right rock in the right place. So you have a very good asset, okay, which helps you to scale. It's a very high quality uh, mineral what you have found, and location is also very good. So we'll take some examples. Ultra Petroleum. If you see Ultra Petroleum, you can see straight away. They drill. So when they drill, they find gas at a very shallow level, and they just spend $7 million. Whereas industry average, they spend around 17 to $25 million. So you can understand how profitable they are. So when they bought, they also didn't knew that such a shallow level they will be able to extract the gas. Correct. And now it has become a very good asset. Like that. Correct. One more example is rock on this compass minerals. So at 100 feet thick, they got very good reserve. Now, but I have taken here now better example. That is the Indian example, the Archean Chemicals. Okay, so they command a leadership position in India in bromine. So it's a leading specialty marine chemical manufacturer in India. Export bromine and sulfate of potash over around the world. RC is the largest exporter of bromine and industrial salt in India, and has among the lowest cost of production globally in both bromine and industrial salts. You can understand, very, very interesting company. Okay. Something more interesting I'll tell you. So it's a cash cow for them. And now what they have done is, whatever money they are making is the latest update. So this also you can keep in mind. What they are doing is, they have invested in some few companies. They have acquired one company from NCLT, which they will be making operational. They have invested in one uh, wafer fab limited, one company. What they will do, they will be into broader semiconductor strategy through SIMCON. Okay. And third is, they're putting a plant in some semiconductor plant in Odisha. The facility will integrate the entire process of manufacturing power devices, including a wafer fabrication plant. And fourth is this off-grid energy labs. So they have about some 18% stake here also. That's the energy storage sector. So what happens is, whenever you find such companies, why I took this example is, whenever you find a company like this, where they have find a resource or a mineral which become a cash cow, what they will do is, after some time, if they are diversifying that money to other place, then it's a trigger actually. Okay, so I'll share this on the chart also. Yeah, its IPO came somewhere around November 21, trading at somewhere around 640. 450 IPO came, trading at 640. In between, price went to 450 again, same at the IPO price. Very, very interesting stock. Keep in your radar. Yeah. trading somewhere around 40 times. 41 times it's trading. You can see PAT of 191 crores, that of 235 almost. This will be, I'm sure this will be only working capital. And IPO also, I don't think they will be needing money, just it will be offer for sale only. IPO details, IPO got listed, offer for sale. 675 crores offer for sale and 800 crores fresh issue that will be utilized for redemption of non-convertible. So they have just redeemed the debt like that. Yeah, 50/50. A good, this one. Okay, and you can see here, leading exporter of industrial salt. Commands a leadership position in Indian bromide merchant sale. Yeah. So, and lowest cost of production globally in both bromine and industry. So very, very interesting company. Keep a track, and the best part is they do con call also. So you can go through the con calls also. Very, very interesting. It's my radar. Okay. One more company is there, paper pulp in Brazil. What they do is, again, very lowest cost producer of paper. What happens is the Brazilian climate allows trees to mature in 7 years versus 10 in Chile and 20 in North America. So generates more pulp with less capital over time, creating a perpetual cost advantage based on unique biological asset. Now here I have done a comparative analysis table. I have taken all those companies which we discussed. The superpower is Southwest is Smart Process, competitor big major airlines. Dell Smart Process, IBM Compact, again, local query, lucky location, Ultra Petroleum special asset. They have like $7 million is their cost of extraction of gas compared to other, which takes 17 to $25 million. And paper special asset. Okay, where same 7 years for to mature the climate allows trees to mature in 7 years, but 10 in Chile and 20 North America. So lowest cost producer. Okay? So now what is the key takeaway? Okay. So if process based, they often rely on competitors' inertia or poor execution. So monitor closely if competitor is able to replicate that. Okay. Very, very important. If competitor is able to replicate that, then what will happen? That cost advantage will no more be there. Better you just try to take your calls. If you are there in that particular stock, obviously you would like to come out of it or book some portion of it. Okay. Second, location based. Yes, geography is fixed, regulatory barriers, protect existing assets. So it is good. So look for companies serving markets with high transportation costs for their products. Correct. And unique asset based goals, and the asset itself is the moat. So analyze the quality and longevity of the resource deposit, result in best class profitability. But what I am telling you is add one more thing is how they're whatever they're making money, are they diversifying into other assets where they can again generate more return on capital, correct? Invested capital. So whatever their asset is there, whatever returns are they're getting in the existing capital what they have invested, the new asset what they're buying, their return should be more, correct? So that is how when you see the diversification, it really helps, correct? So that is why I took example of Archean chemicals. Okay. Not only that asset, because see what will happen, it will be just like a cash cow. It is just coming, going on. So, or asset is there, they are investing more and increasing the capacity. So then it makes sense, correct? But if they're diversifying with a higher return on capital, then nothing like that. Correct? That's why I took that example. So the bottom line is durability is the key. Smart process can be copied. Watch this closely. Lucky locations are hard to copy. These are strong. Special assets can't be copied. These are the strongest. So out of three, which is the strongest is special asset because that cannot be copied. So when you get three options, you get three stocks. Okay. You find three stocks. And in that one is has a special asset, valuation is reasonable, and they're doing capex. They're going into some new industries, correct? Where again returns are more, go for that. Okay, context matter, cost and only matters if customers are shopping based on price. Again, price is the key. If price is the key, two products identical, then cost is very important. Okay, so you're doing a research on a company where there are so many competitors, and and cost is the only thing, then focus on cost, correct? Because both the features are same, giving uh, same kind of output, correct? But so there, whichever is cost, people will buy that product. Okay. It's not just about being cheap. The goal is to be profitably be cheaper. Okay. Because of defensible reason that competitors can't easily take away. Again, remember when it is about cost, the competition will be very high. And I have given you examples how to find that. The best way to find is see the margin. If margin is low, it is a commoditized product. Simple. Okay. So very, very easy to identify. I've already given this mantra. Whenever you see the margin is low, be careful. Okay. That means there is a competition. Okay. Like that. So yeah, that's all from my side. Thank you all for joining. Any questions you can ask. I hope I was able to summarize some key importance. What should be the time frame? What should be the structure in your mind when you're identifying the stock, correct? Very, very interesting concept actually. And I took one interesting example also, Archean Chemical. Okay. Very, very interesting.
This will definitely build a base for us to think actually.
Yes, yes. Read this Archean Chemical, very interesting company. So anyone has any doubt or any stock they want to discuss, we can discuss. Otherwise, I'll close up.
Niraj, I wanted to ask about gold thing.
Take it. I'll just stop this session recording.
Yeah.
So thank you all of you for joining. I'll just stop the recording.